Hi, welcome to Chapter 14, Financial Statement Analysis, Part 1. And there are 4 parts to this. We're going to define financial statement analysis, and also we're going to look into one area of horizontal analysis. We have other areas in this chapter. We have vertical analysis, ratio analysis, earning power, and the quality of earnings, and they'll be addressed in the subsequent parts. When we do analysis on financial statements, we both look back, sort of a forensic analysis, looking at our past performance and reporting on it. How were sales this year? How were sales this month? And we look at our current position, which really means our balance sheet. We also look forward to the future, and we make an assessment as to whether we expect sales to maintain or grow. What are the chances of that and the risks associated with it? Where do we get financial statement information? We first look inside the company. We look at the 10K, the company's own website, and the company's own press releases. Because this information is coming from inside the company, there is a potential for bias. We also look outside the company, and these are independent analysts external to the company. They are not employees. And we have lots of sources for these: Standard & Poor's, Value Line, Hoover's, Dun & Bradstreet, Moody's, to name a few. You can go out and look up these websites. They are accessible. They all contain data that is free. They also contain data that you can pay for, a subscription, and access more data about companies. We generally place a higher value on external analysts because they are not paid by the company. When we do our forensic analysis, there's 3 types of analysis we use: horizontal, vertical, and ratio. And I'm going to start by talking about horizontal analysis. Horizontal analysis looks at trends over time. So it may say, if this year's sales were $6,000 and last year's sales were $5,000, sales grew by $1,000. You are always comparing it to the base year. And the base year has to be defined. And so if you have more than 2 years of data, 3 years of data, 4 years of data, the base year is usually the oldest year. So let's say 6,000 this year, 5,000 last year, $1,000 growth compared to the base year of $5,000. 1,000 divided by 5,000 is 0.20, or 20% from the base year. So we'd say that's a growth of 20% over the base year. We use horizontal analysis for the balance sheet and the income statement. And we actually, in real life, we use it for other reports as well. Anything where you're tracking things year by year, you would compare what you're spending or what your revenue is compared to the prior year. An interesting number to compare is this year's money spent on travel compared to last year's money spent on travel. This year's money spent on training compared to last year. But we're going to really just focus on the income statement and the balance sheet for this chapter. Now I've pulled up the Kellogg's income statement here for the years 2009, 2008, and 2007. Now, even though those year-end dates are in January, you can see January 2nd, 2010, we would say that's fiscal year 2009 because only 2 days of that year were actually in 2010. The same is true for the year ending January 3rd, 2009. We would say that's fiscal year 2008. And of course, the prior year you can see actually ended in December, and that's 2007. So we're going to get into how we calculate these trends, and then we're also going to write about these trends, and I'm going to give you some sample writing to do. The base year is always the 100% number, and it's for each line item. So for the sales, the base year number is 1176. For gross profit, it's 5,179. For total operating expenses, 3,311, and 1,103 for net income. We then would compare the next year to the base year, take the difference, divide it by the base year, and get our percent growth. For the third year out, we would compare again to the base year, take the difference, divide it by the base year, and get our growth. So just looking at sales, you can see that they had a significant growth in 2008, but they fell back a little bit in 2009. So compared to the base year, we jumped almost 9%, but we slid back to 6.78%. And you would talk about those trends. You, as a writer, you don't know what the reason is behind it. You just want to identify the trends. So this would be a sample writing. If I had this data in front of me, I would say sales grew in 2009 compared to 2000. I'm sorry, sales grew in 2008 compared to 2007. However, they dipped in 2009. Now, with more space, you would quote actual numbers and percentages to just strengthen your argument. So you might say sales grew in 2008 to 12,822 compared to 2007, 11,776, comma, this is a growth of 8.88%. Net income grew each year. 2008 with a 4.08% growth over the base year, and 2009 with a 9.88% growth over the base year. Reviewing costs, Kellogg's operating expenses grew at a much slower pace, which we know is good news. 3.11% over the base year, and actually they reduced operating expenses in 2009 to 2.39% growth over the base year. Kellogg's gross profit improved in 2009, even though its sales did not. We see how sales slipped a little bit here, but look, gross profit did not. This suggests that Kellogg's is controlling its costs, particularly cost of goods sold. And here's just showing the calculations. And I would encourage you to stop the video at this point and go back and review those calculations and make sure you know how to calculate each and every one of those percentages. Horizontal analysis is also used on the balance sheet. So again, the base year, and then each year compared to the base year. In this example, you can inspect and see that 2521 is less than 2717. So when you subtract, you're going to get a negative number. And that just means that current assets went down 7.21% compared to the base year. All right, so summary in the writing, total assets are decreasing, current assets are decreasing at a faster rate compared to long-term assets. Total liabilities increased in 2008 but dropped down to 2009, suggesting that the company is maintaining the same debt levels. Retained earnings has grown by almost 30% over the base year, indicating that the company has been profitable. Now, retained earnings on a balance sheet is a real helpful number because if it grows, you know the company made money. And that's a good thing. And again, for your written analysis, you'd want to quote percentages and dollars growth as well as just the conclusion. You don't know what happened at Kellogg in these 3 years. You're just analyzing the changes, the growth rates. So the questions you want to ask as you analyze balance sheets and income statements is, what changed and in what direction? Did assets go up? Well, if assets went up, we want to look at liabilities and stockholders' equity to see how these assets were paid for. If liabilities didn't go up, then you know the company is generating enough cash from its profit to finance its asset growth. Income statement. Are sales increasing? Are costs following sales? We would expect if sales rises, so would cost of goods sold. It would not make sense for cost of goods sold to go down if sales were going up, unless, or I shouldn't say it doesn't make sense, but you would ask a question as to why that happened. Maybe one of your parts or items that goes into your product had a price reduction. But these are good questions to ask. So you look at changes over time, and you look at changes that should be dependent on other areas, sales and net income. If sales go up, we would expect net income to go up as well. This concludes part 1. Let's go on to part 2.